Chapter 11 is Shareholders Equity. I really like the Shareholders Equity chapter. I think it's a chapter that most students do really well on the final exam. There is one thing that is not in the webinar problem, so I'm going to add it to the webinar problem. So be aware that the webinar problem is a simplistic problem that I wanted to start with, because I think it's important to start with a simpler problem. And then what I'm going to do is I'm going to increase its complexity as we move through the question. All right, so shareholders equity is, there's two ways a company can well, there's multiple ways, but let's assume that there's two ways a company can finance their operations, and one of them is finance the business, and one of them is through debt, which we did last week, and the other one is through equity, which is selling shares. So the first question we're going to do really covers the sale of shares and how those kind of transactions are recorded. We've already done we already did dividends. If you remember in Chapter 3, we did questions where we paid out dividends, but it was very, very simplistic. We just said the company paid dividends and that was it, and we just did an entry, a debit to dividends and a credit to cash. But we didn't do any of the complexity with regards to paying dividends. So we're doing two things. We're going to deal with shares and share transaction, and I'm going to help you to understand the true transactions that would be involved when we are paying dividends. All right, so let's jump right in. Let's jump right in with Q11-1, because I think this is a good question and it shows you all the basic transactions. When a company has shares, we want to start right away with doing T accounts so that we can quickly track what is happening. This company has preferred shares, and the preferred shares have a historical cost of $1.5 million. That's a historical cost because that is the value when we sold the shares. What's important to track with shares too is the number of shares. If you don't have the number of shares, you actually will make a lot of mistakes in your transactions with regards to dividends. So in this case, the number of shares is 5,000. So let's just talk for a moment about issued, outstanding, and authorized. So authorized is the total number that can be issued by the company. And in this case, I am speaking specifically about public companies. I'm not speaking about private corporations. I'm speaking about public corporations that list their shares on the stock exchange, any stock exchange, wherever they happen to be. So authorized is the total number of shares that can be issued by a company. And so this is based on the articles of incorporation. So corporations can be incorporated either federally or they can be incorporated in the province where their head office resides. And companies can be both also, and they can be incorporated in multiple provinces. So you might have a corporation that's incorporated in Ontario, but they also have federal incorporation. And so the articles of incorporation indicate how many shares are authorized. And the most common thing to see right now is unlimited for common shares. So you'll see unlimited. And that's because if you authorize, let's say you authorize only 7 million shares in your articles of incorporation, to change that is a fairly big endeavor. So it's a lot better to just say that it's unlimited. You'll notice preferred shares tend to have a smaller number that are authorized. And again, this is all based on the articles of incorporation. Now, issued is the number of shares sold. Is the number of shares that are sold to the public. So if I issue 10,000 shares, those are sold to the public. Outstanding is the number of shares in the hands of the public. And when I say public, it could be, a pension plan or a mutual fund, but it's in the hands of the shareholders. Generally, issued and outstanding is the same, but it doesn't always have to be. I may issue a bunch of shares, they're outstanding, but then I repurchase as a corporation, I repurchase some of the shares. Now they're no longer outstanding, but they still at one point have been issued. So these two numbers do not have to be the same thing, but sometimes they are. You can see a company that says issued and outstanding. All right, so now we have a better understanding of the terminology. We'll go back here and we'll see that this company has 5,000 outstanding shares, so in the hands of the public, but they have 50,000 that are authorized for the preferred shares. Oops, let's talk about preferred shares and common shares. Go all the way over here. So, preferred shares. So preferred shares get preferential treatment with regards to dividends. They are paid dividends first. In fact, a company cannot pay common share dividends unless all the preferred shareholders have received their dividend first. So they get preferential treatment, hence the word preferred, right? Preferential treatment with regards to the payment of dividends. They also are paid first if the company dissolves. So if the company dissolves, the preferred shareholders will get the leftover. Don't forget, preferred shareholders are still after the secured shareholders, sorry, the secured creditors and the unsecured creditors. So remember that it's assets equals liabilities plus equity. Well, we can increase the complexity of this. It's assets equals liabilities plus preferred equity plus common equity, right? So you can see the progression. These guys are paid first, and then these guys are paid next. And then what's called the residual shareholders, they're paid last if a company is dissolved. So preferred shareholders have preferential treatment. Now, preferred shares can be voting, but they are most often not non-voting. Now, when they give up the right to vote, common shareholders have the right to vote. Most preferred shares are non-voting. When they give up the right to vote, they gain other rights, because why would anybody buy a preferred share and not have a voting right if they weren't going to get some kind of benefit from purchasing preferred shares? So preferred shares have other benefits. They can be cumulative. They can be convertible. They can be participating, right? And they generally have a set dividend. And don't forget, they get paid their dividends first. So they'll have a set dividend. So what you'll see is you'll see a preferred share, and then you'll see a dollar value. So looking at our preferred shares, back over here, you'll notice on the sheet the preferred shares have a number right after them. $4. And most students think that that is the selling price of the preferred shares, but it's not. It's the amount of the dividend. So these preferred shares will receive $4 in dividends. Now, if it doesn't say cumulative, then the shares are not cumulative. And we don't deal with cumulative shares here because the level of complexity is beyond the scope of this course. But in this case, these preferred shares have a $4 dividend. Now, quite frequently on the final exam, students have written me emails afterwards and said, you know, you had a question on the preferred shares, and you made me, you know, you made it so that they had a dividend, but you didn't give me the dividend amount, so I couldn't do that part of the question. I think it's an error in your exam. Well, it's not an error in my exam. The error is that the student didn't realize that the number that's either immediately after the word preferred shares or immediately before the word preferred shares, because sometimes it's located here, is the amount of the dividend, not the amount that the shares were sold for. So be aware that the dividend amount is shown very prominently because the preferred shareholders, or sorry, somebody who wants to be a preferred shareholder needs to know what the preferred dividend is going to be. So this one, it's $4. All right. So any questions about preferred shares, or are we good to go? Looks like we're okay to go. All right, so let's keep going with our T accounts. We've got another one for common shares. So common shares have voting rights, but basically you don't have to pay common shareholders any dividend any time, right? You just don't. There are companies who have never paid dividends, and there are companies who pay dividends on their common shares every single year. But common shares are, you purchase a ownership interest in the company, you have a voting right with your share, and generally the voting right, generally, not always, but generally the voting right is you get one vote for every share you own. So this is common shares, and you really don't have any other rights aside from being able to vote with your share. because it's ownership rights, and that means you could increase the value of your shares on the open market because the company's doing really well. They might decrease because the company's doing badly. You might get a dividend because the company's doing well and is paying dividends. You might not get a dividend because the company just doesn't pay dividends. So common shares really are an ownership in the company, and the max that you can lose is the amount that you paid for the shares when you bought them. So in this case, the common shares are worth $7,652,000. That's, again, their historical cost. When we sold these common shares, that's how much they brought in. And then the number of shares, which is really, again, such an important factor. The number of shares right here, in this case, is 210,000. So that's the number of shares that right now is outstanding in the hands of the shareholders. And then we've got, finally, retained earnings. And the retained earnings here is sitting at 1,250. There we go. All right. So now we're going to do the basic transactions for these shares. And then I'm going to complicate your life by doing other things. All right. Now, when we do these transactions, we're going to make sure that we update our T accounts every single time we do a transaction. So on February 8th, the company sold 10,000 common shares for $28 each. So 10,000 common shares times 28 is equal to $280,000. So what did we get? We got cash of $280,000. And of course, when I say we, I mean the company. And what did we give away? We gave away ownership in the company in the form of common shares, $280,000. So now over here, we've got $280,000, which now becomes the historical cost of those shares, and the number of shares is 10,000. Now, just so you know, if I sold preferred shares, I would sell the preferred shares in the exact same way. I would do a debit to cash and a credit to preferred shares. That's the only thing that would change. And of course, the value also, because the preferred shares probably are selling for a different price. But this transaction is common for both common shares and preferred shares. So now let's pay the dividend. So we've got 3 dates. The dividend was declared on June 28th to shareholders of record on July 18th, and then it was paid on July 28th. So let's go through the 3 dates. So when you're paying dividends, there are 3 important dates where things happened. So the first one is the date of declaration. When a board of directors votes, unanimously votes, to pay a dividend, at that very moment, it becomes a legally binding contract between the company and the shareholders. A company cannot renege on dividends that they have declared at the board of directors. So if a company declared a dividend and then reneged on it, the shareholders could actually sue the company and the shareholders would win. So it is a legally binding contract in the moment that the board of directors votes to declare a dividend. So because it's a legally binding contract, it results in a liability immediately. So we're going to have a credit to dividends payable. Dividends payable is a liability account because it will result in a cash outflow in the future. So that's a definition of a liability, right? Due to a past transaction, a future obligation that will be settled through the outflow of resources in the company, in this case cash. So it meets the definition of a liability, so we've got to record it. Now, what's going to happen when you think about us paying dividends? When we pay dividends, we are actually distributing wealth from the company. And if you remember when we were doing our assets equals liabilities plus equity, and we did equity is equal to contributed capital or share capital slash share capital and retained earnings. And retained earnings, of course, was equal to opening retained earnings plus profit, also called net income, and then minus dividends. So you'll see that dividends are a distribution of wealth, and they come out of the equity side. They don't come out of of anything else. And you'll notice they're part of the calculation of retained earnings. Now, in this textbook, they use the account called dividends. Some textbooks call it cash dividends. Some companies call it cash dividends. Some call it dividends cash. Some call it common share dividends cash. The choice of account is, I'm not too fussed about that in the final exam. Most companies, in reality, put the entry directly to retained earnings. So that's just what I've seen in real companies. I've never seen a company use a dividend account. It's not that companies can't. Absolutely they can. And if you look back at Chapter 4, you'll realize that the dividend account is closed to retained earnings at the end of the year when we do our closing entries. That's from Chapter 4 if you want to look back at that. But many companies do it directly to retained earnings. So how do we calculate the amount of the dividend? Well, these are, and you'll notice it doesn't say anything about the dollar value, these are preferred dividends. So when you're looking at this, well, we know the preferred dividend, it's right here, it's $4. How many shares are outstanding? Right here, 5,000. That indicates exactly what's going to happen. So we're going to do the 5,000 shares times the $4, and that is equal to $20,000. Now, I'm going to go back and I'm going to reflect it right here. Now, I did my entry to retained earnings. Keep in mind that you could have a separate account called dividends, which also belongs under retained earnings. But I'm going to do my entry directly to retained earnings. I'm not going to have a dividend payable account here because I don't really want to start tracking the liability accounts. There's not that much room on my page. So notice again, date of declaration, legally binding contract. Then we've got on July 18th. This is called the date of record. On the date of record, what happens is after the close of trading on that specific day on the stock exchange where these shares are traded, a company, generally a trust company, will list down all the names of the owners of the share. So on July 18th, if you own the shares on July 18th, your name will be noted down as an owner of shares, and it'll tell you how many. So you'll have a huge list of all the shareholders who own shares on July 18th. So this has no entry. There's no entry because we're not doing anything. We're just listing down everybody's name. Now, let's assume that somebody sells their shares on July 19th. Will they receive the dividend? They will. They will receive the dividend. The individuals who receive the dividend, it is no longer based on the pay date. That's right. That's right. On the date of payment. But the ownership of shares is connected to receiving the dividend before the date of record. But after the date of record, you no longer have to own the shares in order to get the dividend because your name was listed down on the date of record. So remember, ownership of shares counts between these two dates. Right? But after the July 18th date, it actually doesn't matter whether you own the shares or not. You can no longer own the shares, so I could have sold my shares on July 20th and I would still receive the dividend because I own the shares on the date of record, and that indicates who will be paid. So then the final date is on July 28th. And remember, on July 28th, on the date of payment, you don't have to own the shares. You could have sold them right here on the 20th, right? And it wouldn't make any difference. You would still receive the dividend on July 28th. So this is called the date of payment. This is the date when all the people whose name was listed down on the date of record get paid. So what do we get? We get back our IOU to all these shareholders, so the dividend payable disappears. And what do we give away? We give away cash. And it's in the amount of the dividend that we already calculated previously. All right, any questions about the 3 dates with regards to cash dividends? It looks like we're good to go. Now, I want to track for a moment what's happening. So if we're looking at assets equals liabilities plus equity, when there is a cash dividend, what happens to all these factors? And I'm talking net. So not at the date not at the date of declaration or anything. I'm talking about net at the end of the time period after the after the dividend has been paid. Yes, you are correct. Cash decreases, which means assets decrease, and equity through retained earnings decreases. That is the net impact, and I mean net, after the date of payment. This is the net impact. We do have a liability impact, but only between the date of declaration and the date of payment, and then it disappears. So I'm doing the net impact, all right? So we're going to compare that to a stock dividend. And we're also going to compare that to a stock split. There we go. All right, so let's go back. So we're sitting here, everything's looking good. We already did these entries. So now let's move on. 3, the company declares a 10% stock dividend to common shareholders on August 20th. Oh, we're going to jump back to here for a second because I forgot to add something. I'm going to change my color for a second so it's very clear. So when can a company pay a dividend? So 1, it must be declared, right? That's just a given. 2, by the board of directors. 2, you must have cash that is greater than the amount of the dividend. And 3, you must have retained earnings that is greater than the amount of the dividend. If the company does not have retained earnings because they've been in a loss position, what do you mean quarterly or annually? Nicole, I just saw your posting. I apologize. What do you mean by quarterly or annually? Oh, a company can pay a dividend whenever they want. There's companies that pay quarterly dividends or semi-annual dividends, or annual dividends. These things happen in the exact same way. Okay, there's still a date of declaration, a date of record, and a date of payment. So let's assume that a company does a date of declaration where they declare that they will pay a quarterly dividend of 6 cents. So, and they are already declared that they will pay, and they give the dates of when it's going to be paid. In that case, you've got to do a dividend payable for all of the dividends that have been declared. But other companies may declare only a quarterly dividend. So they just say, I'm going to pay 6 cents on this quarter. They only have to do a payable for that 1 quarter because they've only declared the 1 quarter. All right, so when can a company pay a dividend? All 3 of these things have to be in place for them to pay a dividend. So how can a company pay a dividend? 1, let's say a company has cash flow problems and they don't have cash. Can they pay another style of dividend? And the answer is yes. A company that doesn't have cash would not be able to do a cash dividend, but they would be permitted to do a stock dividend. So we're going to look at stock dividends because companies who do not have cash can do a stock dividend, and it'll still keep the shareholders happy. No, that's a different thing, Christopher, and that is the second level of intermediate accounting. So that's, yeah, stock compensation. But it's not at this level of accounting. All right, so now let's do a stock dividend. So this company declared a 10% stock dividend to common shareholders on August 20th to shareholders of record, no problem, Christopher, to shareholders of record on September 2nd. Issued the shares on September 20th. So we've got a date of declaration of August 20th. So again, we still have a date of declaration. It's not like that disappears. And our date of declaration is August 20th. So what happens at that date of declaration? Well, first of all, we have to calculate the amount of the dividend. And that is more complicated than it is when it's just a cash dividend. So when we look at this, let's go back to our public page. We see that the common shares have a value. 0, 0, 0, 2, 13, 6, 7, 8, 9. Okay, so that's the total value of the common shares right now. That's not something we use for a stock dividend, but it's one of the errors that students make. They will use this dollar value, but this dollar value is history, and we don't use history. We use the number of shares because that is not reflecting history. It's just a nominal number of shares, right? 220,000. So it's the number of shares that we use in order to calculate, oops, where's my page? In order to calculate the number of shares that we will issue. So we have 220,000 shares. And we're doing a 10% stock dividend. So we multiply those two things, and that's 22,000 shares. All right? So that's the number of shares. Now, the worst thing I see is I see students now write this down as the entry. They'll write it down as the entry, 22,000. But that's not a dollar value, that's 22,000 shares. How do we determine the dollar value of our entry? Well, we take those 22,000 shares and we multiply times an amount. What amount should we use? Well, the market value of the shares. So we have three market values here, 29, 31, and 28. Which value should we use to multiply times these 22,000 shares? What are our thoughts on this? 29. Absolutely. In fact, we can't use the other values because we're standing in August 20th. We wouldn't even know these other two values. They just put them in the question to confuse you. Oh, where did I get that number? If you go back to our first sheet, you'll see that that is the number of shares outstanding at this time. And so to calculate the number of shares, we multiply it times the number, to calculate the number of shares we're going to issue for the stock dividend, we use the number of shares that are outstanding at that time and multiply it times the percentage. All right, so we decided it was $29, so we're going to do the multiplication here. So that is $638,000. That is the value of the shares we're going to issue. Because when we issue these shares, right, shareholders could sell these shares for, well, right now, $29. So it makes sense that we're going to value the shares we issue at the price that is existing on the stock market right now. So we got a debit to stock dividends, or of course, what I'm going to use is retained earnings. And that's $638,000. We're going to credit, what account are we going to credit for that $638,000? No, we're not going to use dividends payable, and I'm so glad you said that, Nicole, because it is the number one thing I see on the final exam. So we can't use dividends payable. Well, we can't use stock payable either, but we can't use dividends payable. We can't use a payable account. We can't use a liability account because this will never be settled with cash, goods, or services. And if it's a liability, it must be settled with cash, goods, or services. So we can't use that account. Instead, we have to have a holding account that recognizes what's going to disappear is not cash, but shares. So we use an equity account called stock dividend distributable. This is an equity account. It sits immediately under our common shares account. If we were to produce the financial statements right after this entry, that's where you would see it. So we've got to use stock dividends distributable, an equity account, because what's going to flow out from the company? It's not going to be cash, it's going to be equity. So that's what we have to use. Don't be tempted to use dividends payable. which is something I see all the time because it's not going to be settled in cash. So now, what entry do we do on our entries? Well, nothing's going to change in the common shares because I haven't issued any common shares right now, right? The only thing that's going to happen is the, wait 1 second, for the $638, 638,000 is 638,000 is going to go here because of retained earnings. And again, you could use a dividend account. I'm not saying you can't use a dividend account. I just tend not to do that. So now the next date we have, of course, is the one on September 2nd. This again is the date of record. And we already know that there's going to be no entry on the date of record because all that's happening. Can we use dividend account on exam? Of course. Absolutely. Absolutely. On the exam, you've got to imagine yourself as the accountant. So the choices you make are your choices that work for you. I show retained earnings because if you work for a company, that's generally what companies use. I've never seen a company use anything except for retained earnings. So I show that because it's the most common. Plus, when you move up to the next level of accounting, I don't know if all of you are going to do that, but if you do, you'll realize that in those textbooks, they always use retained earnings. But absolutely, you can use the dividend account. There's nothing wrong with that. As long as you remember that it's got to be closed at year end to retained earnings. So we know that there's not going to be any entry on the date of record. It's just going to be a listing of names. And now we're at September 20th. Now previously when we were doing a cash dividend, this was the date of payment. But now it's the date of issue. It's the date that you actually issue the common shares. So what's going to disappear? The stock dividend distributable. That account is going to disappear because we no longer owe anybody common shares. Why not? Because we're about to issue them. At this date, we can now finally update. We can update the common share account. 638,000 are going to be credited, and that is 22,000 shares. All right? That's what we're sitting at right now. So now, let's go back here. That was the date of issue on September 20th. Now, what's the next thing that we're going to do? Well, it says profit in 2017 was $284,000. So we ignore the $28. Absolutely. We ignore the 31 and we ignore the 28. Makes absolutely no difference whatsoever. It's in there as a red herring. Oh, the entry to the retained earnings account. Did I forget to make the entry to the retained earnings? No, I have it. I have it. I did it when we did the stock dividend distributable. Technically, we should have a stock dividend distributable account, which would have ended up with 638 in the first date and 638 then in the next date. So really, the stock dividend account only exists for what? That 5-week period or 4-week period or 3-week period? So we already did that entry. So yes, ignore all of the other amounts because they make no difference. We do the entry at the date that, we do the entry for the amount at the date of declaration, and we don't change it later. All right, so now we're at number 4, profit. We know when we're doing closing entries, as per Chapter 4, our closing entries always close all the revenue. So we do a debit to a revenue. These are closing entries. And they're from Chapter 4. So we do a debit to a revenue and a credit to retained earnings. And we do a debit to retained earnings at, sorry. Income summary. My apologies. And a debit to income summary. I jumped the gun, and a credit to the expenses. And by doing so, we change all the expenses into zero on the income statement, the revenue into zero on the income statement. No. I'm just giving Diane, I'm giving an example of closing entries from Chapter 4. I'm just trying to do a reminder. Now, the last part of the closing entry is to clear out the income summary account. So we do a debit to income summary. And we do a credit to retained earnings. And this is what we have to do at December 31st for this company, because we were told that profit was $284. So what I'm assuming is that these other entries that we've got right here, these entries have already been done. When the question simply tells you that this is the amount of profit, then it's telling you that those two entries have already been done and everything is sitting in the income summary account. So make sure you take it out of the income summary account and you put it into retained earnings. So that's what I'm doing, just reminding you of that. So now we're going to go back to our T accounts because we want to put this into our retained earnings account. So that is $284. And now our income summary, of course, would be sitting at zero. All right, so we now have all the information on all the transactions done. So I'm going to carefully add up what the values are. We know preferred shares are there. Retained earnings, I'm going to add this up. I've got the 1250, 123, add in the 284, subtract the 638, subtract the 20, and the value is, I hope one of you guys can confirm this. Okay, good. And then the common shares, 7652 plus, okay. I have 8570123. Did anybody else get that? Yep, perfect. Okay, so now we have the necessary information because the next part of the question says, provide the statement of changes in equity in 2017. And then we're going to do the equity section of the statement of financial position, which you've already got a model for, but I still think it's a good idea to try it. All right, so, whoops. We're here right now. Let's do the statement of changes in equity because we haven't done that since, Chapter 1. I want to make sure you understand how to do it. So, starting with the statement of changes in equity, we start with the company name. Wait, I'm trying to find out what this company was. Oh, Green Inc. Then we do statement of changes in equity. Then we do year ended. This was 2017. Okay, on the statement of change, we didn't do the impact on the accounting equation. Right. Thank you very much for reminding me. I think we're here. No, go back one. There we go. Okay, stock dividend. There was no changes in the asset. There was no changes in the liability. Retained earnings went down and common shares went up. So the net impact is zero. So you can see what a difference it is when we're doing a stock dividend. There is no change in the financial position of the company from before and after the dividend, because we're basically shifting value from retained earnings over to the common shares. Note that in order to do a stock dividend, you still have to have retained earnings in excess of the amount of the stock dividend. Because remember when we were talking before, wait one second, I'm just going to go back here. Remember I said we have to have declared and we have to have dividends that are greater than, retained earnings that are greater than the dividend. We don't need number 2 when we do a stock dividend, but we still need number 3. Okay. So now, when we're doing this, the lovely thing about having those T accounts is that it totally ties in here. We need to have the preferred shares, common shares, and then we need to have retained earnings, and then we need to have a total. So we start with the opening balance at January 1st. So what can I use to do that? Well, the perfect thing to use is my T accounts. All those opening balances at the beginning, those are the balances that I want to put in here. So when I'm looking at it, I'm going to choose this number, right? I'm going to choose this number. I'm going to choose this number, because those are all the opening balances. So I use the opening balances in order to create my statement of changes in equity. And as I look to see the changes that happened, I'm going to use the information in the T accounts also. So in this case, preferred shares was 1,500,000. And then common shares was 7,652,000. And then retained earnings was 1,250,000. And then the total was, oh, wait a minute, I realized I didn't mark down the total. Okay, 10,402,000. So that's the start. Oh, thank you very much, Clarissa. All right, so now, is there any order to the items that go on here? And the answer is no. There's no specific set order that you need to do. IFRS and NASB don't say that there's any set order. I just do whatever I want. So I'm going to start with, you could start with whatever you want. I'm going to start with net earnings or net income. Now, look at this. This is a perfect tie-in, right? Where did net income go? Well, it went under retained earnings under credit. So I know it's going to increase retained earnings, 284,000. So I go back here and I put down 284,000 right here, and I put 284,000 on the total. By having it in the T account for retained earnings, I know it has to go in the column for retained earnings. Then I had preferred shares, cash dividend. Well, if I look back at where did the cash dividend go in the T account, the cash dividend went right here in retained earnings as $20,000 debit, which is a decrease. So I know it's going to be negative 20,000. Okay, I had a common share stock dividend. Where did it go? Well, wait one second. It went in two places, right? It went right here for the retained earnings, but it also went right here for the common shares. So it increased the common shares and it decreased the retained earnings by 638,000. And remember, I said, what's the impact? The total net impact is 0. So we've got these three things. We issued common shares. So again, we go back and we look at the T accounts. It tells us everything we need to know. We issued common shares for $280,000. So now I know that that went under common shares increase, $280,000 and then $280,000. If we now add all these amounts together, we will have the closing at December 31st. Those closing amounts should equal exactly what we have in the T accounts. If they don't equal what's in the T accounts, then we know that there's a problem. So if I look at the T accounts for common share, it was $8,570,000. This is $8,570,000. Retained earnings over here was $876,000. And then the total. And the total you can get to in two ways. Okay, I got 10 million. I think I got 10,946,000. Did anybody else get 10,946,000? Okay. And keep in mind, of course, you can add down as well as adding across. And both of those numbers better be equal, otherwise you know that you did something wrong. So this is the statement of changes in equity showing all the transactions that occurred which impacted equity and equity only. I should say it's the only thing that was impacted, but this is what impacted equity, which is important information for the shareholders, right? The shareholders want to know what is impacted in equity. So now, moving on, we can take this information, and this information goes into the statement of changes. Sorry, this information goes into the statement of financial position. So we've got Green Corporation. We have the statement of financial position. We've got as at December 31st, 2017. This is going to be partial. Okay, I'm going to do equity only. And I'm going to start with contributed capital. And then I'm going to do preferred shares. Remember, I'm going to put the dividend here, right? $4. I'm going to put 5,000 outstanding. And then I'm going to do 50,000 authorized. And then I'm going to do the value, 1,500,000. Right? So you can see this is what the statement would look like, right? And notice I've got the contributed capital first. So then I do common shares. And again, I go back to my T accounts because it'll tell me that 242,000 are outstanding. That's where I get my number. Unlimited authorized. And we know what the amount is because it tells us right here, 8,570,000. Then we do total contributed capital, and that's these two amounts added together, 10,070,000. Now we move on and we put in retained earnings. And remember, we get the retained earnings from here, 876,000. And then this is total equity. And again, total equity comes from the statement of changes in equity, 10,946,000. There we go. Any questions about the equity section of the statement of financial position? Or can I move on? Now, one of the things that I did not show you is when we buy and sell common shares. Sorry, I showed you how to issue common shares, which is selling common shares. How a company might buy common shares. Now, companies will purchase their own common shares on the stock market for a number of reasons. One of the reasons, so let's just move on so we know. So why would a company repurchase their own shares? Well, there's a number of reasons. So one, a company might repurchase to increase the value of the shares. Yes, that is actually true. They repurchase shares because when you repurchase shares, there's fewer shares on the open market, and if your company's value is high, that means each share becomes worth more. So a company will repurchase the shares to increase the value of the shares on the open market. 2, a company will repurchase shares because their employees have been given stock options and the employees have enacted the stock options. And so then the company has to provide the shares to them. So those employees who have stock options, they don't go out and buy the stock in the open market. No, they purchase the stock from the company. And it's not like the company can print more shares. They buy the shares on the open market and then turn around and sell them back to the employees at a different price. So it could be because of stock options. Sometimes companies repurchase shares from the open market because repurchasing shares is filed as capital gains on your income tax return, and it has a better tax implication than if you get dividends. So some companies will repurchase shares because the shareholders then get a preferential tax treatment. So they don't give a dividend, instead they just rebuy some of the shares. And then investors can choose to give up their shares or not. So they can choose, yes, I want to give up some of my shares and get cash in return. So there are a number of reasons why companies might, and the final reason, well, there's 2 or 3 other small ones too, but one of the other reasons is the company wants to go private again. So for instance, Empire repurchased all of their shares on the open stock market because they wanted to become a private corporation from being a public corporation. So companies do this, and how do we account for it is really, really important. So let's assume when we're looking at this, because don't forget, I'm going to continue with this same company. I'm going to continue with Green Corporation. So don't forget that Green Corporation has, we said, 242,000 shares outstanding. So let's say the company wants to repurchase some of those shares. So on January 8th of 2018, the subsequent year, the company repurchases 10,000 shares on the open market for, let's say they repurchase them for $30. Okay, how do we account for that? $30 cash, because they have to give their shareholders cash, otherwise the shareholders won't give up the shares. So how do we account for the repurchase of shares? Well, we have to first do a number of things. Number one is we have to calculate the book value for the shares. So how do you calculate the book value? You take the dollar value in the common share account, and you divide it by the number of shares outstanding, right? Well, we can do this using our T account, but we can also do it using this right here, right? We have 8,570,000, and we have 242. 8,570,000 divided by 242,000 shares. What is the value per share rounded to 2 decimal places? Can somebody tell me? 35.41. You got to think, when these shareholders who own the 10,000 shares, they're willing to give it up. They're going to give these shares to the company, and they're going to get money in return. What they're giving up from history is this value. They're giving up a portion of this historical cost. So they're giving up $35.41. That's what they're giving up. So you got to think, in this entry, there's going to be a debit to common shares for the value of these old shares. So 35.41 multiplied times 10,000. That is equal to, right? What does it say under value of shares? Ooh, I'm looking under value for the shares. What does it say under value for the shares? It says the dollar value in the common stock account or common share account, right? Is that the one you're talking about, Nicole? The dollar value in the common share account divided by the number of shares outstanding. You're welcome. Okay, so this is what they are willing to give up, $354,000, $354,100. What are they getting in return? Well, they're getting cash. How much cash are they getting? Well, $30 times the 10,000. Okay, well, they were willing to give up their shares worth $354,000 for only $300,000. So what have they done when they have left the company? They have left value behind. They have left the company and they have basically accepted a loss on their shares because their shares are worth $354,000 and they were willing to accept $300,000. So where does that difference go? That's $54,100. Where does that difference go? Retained earnings. But retained earnings is equal to the profit that the company has retained in the company for future expansion and growth. And this does not meet that definition. No, we have to put it in a brand new account, and it's called contributed surplus. So that $54,100 is going to go into a special account. If we went back to our T accounts over here, we would have another account called contributed surplus. And it would be sitting with the $54,100. Now don't forget what's going to happen. I'm going to get rid of some of my common shares, right? The common shares are $354,100 is going to disappear from my common share, and 10,000 shares are going to disappear from my number of shares, right? Is it contributed capital? Yes, it's part of contributed capital. Yes, it's an equity account. Absolutely, Clarissa. So it would sit, if I had to now do, just so you know, if I now had to do, my statement of changes in equity, where would the contributed surplus go? The contributed surplus would go right here. That would be where the contributed surplus goes. As part of, and then over here, where would it go? Well, it would go right here, right? Because it is part of contributed capital. Because what's really happened? Shareholders have left value behind. So those subsequent shareholders, the shareholders who stay, are getting the benefit of this $54,100. Okay, so now, can we move forward? Everybody understands this? Is there any questions about this? Because I want to do one other example. So now, let's assume that on, let's assume that on March 28th, the company repurchases, let's say 12,000 shares at $44 each. So what we just did is we had an example when the value of the shares we repurchase is less, right? So here's $30, that was the price that we had to pay, and it's less than the historical cost. What happens when the price we have to pay is more than the historical cost, right? So remember, we have to, first step is to calculate the historical cost per share. So let's go back. 8570123 minus 354100 equals. So we have 8215900. And we have 232. So we're going to calculate the historical cost first. So we've got 8215900 divided by 232. and 35.41, same as it was before. Well, that makes sense. We took shares out at $35.41, so our historical cost per share would be the same. So now that is 35.41 times 12,000. That is, no, I did that wrong. 35.41 times 12, 1, 2, 3 is equal to 424,920. Right? How much did we pay for these shares? Well, we paid $44 times 12,000. Equals 528,000. So remember what we did last time. We had a credit to the cash for the amount we paid, 528,000. We had a debit to the common shares for the historical cost, which is 424,920. But now notice that the cash we paid is more. Previously, the cash we paid was less, right? We only paid 300,000 and this was 354,000. Now it's the opposite. We're actually paying more cash. So where do we get this shortfall? Here we had excess, right? Here we had excess. Now we have a shortfall. Where are we going to get the shortfall? And the answer is, well, we get it from two places. The first thing we have to do is we have to empty out the contributed surplus account. If there is a contributed surplus, if there is a contributed surplus, we have to empty out the contributed surplus account first. So that was 54,100. So if we look at the difference here, we have a difference of $103 and $80. So subtract the 54,100. Okay, we still have a shortfall. Where is the shortfall going to come out of? Retained earnings. And that is the 48,980. And you should see now that the entry balances. So let's think about the sense behind this. When shareholders left and they accepted only 300,000 from a value that was 354,000, it made sense that they have contributed the surplus to the shareholders who are left behind. When they take more value than is actually in the shares that they've taken, when they take more value, where should it come out of? Well, it should come out of any value that previous shareholders left behind, and then it should come out of the retained earnings, because the shareholders who are leaving are stealing wealth from the shareholders who choose to stay behind. Okay, so what is the last thing then that I want to do? And the last thing I want to do is I want to show you how to calculate earnings per share. All right, so that's Q11-2. Whoops, I'm going to change back to my black writing. There we go. Okay, so how to calculate earnings per share. The calculation for earnings per share is profit, also called net income or net earnings, minus preferred share dividends declared or paid. Doesn't make any difference. Divided by the weighted average number of shares. And this is equal to the earnings per share. The dollar value, earnings per share. So now, what do we have here? Let's look at this company. We've got opening common shares were 150,000 shares outstanding, valued at $2.45 million. I'm going to show you what a weighted average number of shares means. 2 seconds. Okay, we've got opening $3 preferred shares. $3, of course, is the amount of the dividend. 6,000 shares outstanding, valued at $1.3 million. Then they sold 20,000 common shares on February 1st. They sold 12,000 common shares on August 1st. And then they paid the annual cash dividend to the preferred shareholders on October 30th. And then they give you profit at the end of the year. Well, in that case, I have some information. I already know profit. That's $350,000. Do I know the preferred share dividend? Absolutely. It's the $3 times the number of shares outstanding, which is equal to 6,000. Okay, so all I need is the weighted average number of shares. How do I calculate the weighted average number of shares? I weight, and I mean W-E-I-G-H-T, I weight the shares for how long they have been outstanding and contributing to the profitability of the company. So I always like to do a timeline when I'm doing this. Here's January 1st. How many shares were outstanding at January 1st? And don't forget, the weighted average number of shares is for common shares only, not preferred shares. Common shares only. We only calculate earnings per share for common shares. All right, so how many shares, common shares, were outstanding at the very beginning, January 1st? And the answer is 150,000 shares. How long did these shares contribute to the company earning a profit? And they contributed for the full 12 months out of 12 months. So these shares weighted for the period of time that they contributed to the value of the company is worth 12 over 12, which is 1, which is 150,000. Don't forget, that's the number of shares. So now, we sold 20,000 common shares on February 1st. How long were these shares contributing to the ability of the company to generate a profit? Was it 1 month? Or was it 11 months? Exactly. 11 over 12. Right? They've contributed for 11 months. So 20,000 shares multiplied times 11 over 12 is equal to what? What is the weighted amount of shares? Weighted for the number of, or the period of time that they've actually helped contribute to the company. 18,333, and we just round it to the nearest full share. Okay, so then they sold 12,000 common shares on August 1st. How long were these 12,000 shares contributing to the ability of the company to generate profit? I have 5, August, September, October, November, December. This company's year end is December. So I have 5, yes, 5. Okay, so now 12,000 times 5 over 12 is equal to what? $5,000. No other common share transactions during the year. What is the weighted average number of shares? The total of all of this, which would equal to 333 in 13, 5, 6, 7, 173, 333. Is that correct? All right. So now I can put that number on the bottom here, right? This is equal to 173,333. Can someone tell me what is the earnings per share for this company? Sorry. Don't forget, we're going to take the 350,000, subtract the 3 times 6,000. 1.92 per share. That is the earnings per share. So calculating earnings per share is not a difficult thing. Keep in mind that this formula will not be provided to you. This is not a formula. You know how you get a formula sheet at the final exam? This is not one of the formulas that is provided to you. So keep that in mind. All right? Is this good or not? Earnings per share cannot be calculated based on, for instance, earning per share of other company. It's an absolute dollar value, and it has the same drawback as, for instance, working capital. Because it's an absolute dollar, you cannot compare it to companies of different sizes. So I couldn't tell you whether this is good or bad. We don't know. We would have to look at the company's past years and what we would have expected of them during this year in order to determine whether this earnings per share is good or bad. But don't be caught in the trap of comparing earnings per share between companies. It is not appropriate, and it should never be done. Would I think the higher the better? Well, that depends. What are they doing with all of this net earnings? If they have a very high earnings per share, but they're not they're not paying any of it back to the shareholders, so they're not paying dividends, and then they're not doing anything with the cash to indicate that the company is growing in the future, then the earnings per share number really doesn't tell me anything. It doesn't tell me anything good at all. So is a higher earnings per share better? Yes. But again, this is only one measure of a company, and it should not be the measure that is used to buy their shares or keep their shares. All right. Thank you, everyone. Take very good care of yourselves.